Today, we are diving deep into HCI Group's third quarter 2025 earnings. Now, on the surface, this was an absolutely spectacular quarter. But the market's reaction? Well, that told a completely different and frankly a much more interesting story. And here it is, the central puzzle we need to solve. HCI comes out and delivers a massive 74% beat on earnings per share, and the next day, the stock drops nearly 7%. You know, a huge beat on the bottom line, followed by a big sell-off like that, that's a disconnect, and we're gonna unpack it. So what did the market see that the headlines missed? To really get what happened here, you have to look at this quarter as a tale of two numbers. This isn't just a simple story about one big beat. It's about the conflict between incredible, jaw-dropping profitability and a few subtle signals that really gave investors pause. Okay, first things first, let's just take a moment to appreciate the scale of this beat. The company posted GAAP earnings of $4.90 per share. The Street, they were looking for maybe $2.81. This wasn't just a beat, it was an absolute blowout. They more than doubled expectations. And this right here, this was the engine behind that incredible profit. For any insurer, the combined ratio is everything. Anything under 100% is profitable. HCI delivered a 64% ratio when Wall Street was modeling 82%. That is just an incredible display of underwriting efficiency. And the real key, the driver behind that amazing combined ratio, was this number, a 22% gross loss ratio. I mean, that is exceptionally low, almost unheard of. And it was driven by two main things. One, really calm weather in Florida during hurricane season. And two, something management pointed out on the call, a noticeable drop in just general claim frequency. So you have to ask, was it all just good luck with the weather? Well, not exactly. Management was quick to point out that even if you adjust for last year's hurricane, the loss ratio then would have been around 25%. So this year's 22% still shows a real, genuine improvement in performance, something they say comes down to better underwriting. So with profits this strong, why the sell-off? The bull case looks pretty rock solid so far, right? Well, let's flip the coin and look at the other side of the ledger, because that's where the picture starts to get a lot more complex. And here we go, the first little crack in the perfect story. While profits were soaring through the roof, total revenue actually came in just a hair shy of what analysts were expecting, missing by about 2 to 4%. Now, it's not a huge miss by any stretch, but it was just enough to get people's attention. And that revenue miss leads right into the market's biggest question. A 22% loss ratio is fantastic, no doubt, but can they do it again? Is it repeatable? Even management was careful on the call, noting that the great weather really helped, which basically signals to investors, hey, don't model this kind of performance forever. Now, despite the market's clear hesitation, management's tone on the call was, let's just say, incredibly bullish. They really believe the market is missing a huge strategic piece of the puzzle that fundamentally changes the company's value. CEO Paresh Patel's opening remarks really set the stage. He framed the whole quarter in terms of long-term value creation. He kept pointing to what he believes really matters, the profits, the efficiency, and most importantly, a rapidly growing book value. And this is the core of their argument. The recent IPO of their tech subsidiary, Exzeo, wasn't just about raising some cash. No, it was a really clever strategic move to force the market to finally recognize this valuable asset that was, until now, kind of hidden on HCI's balance sheet.
So the bottom line is this. That single transaction, the IPO, is expected to boost their book value per share, a really key metric for insurers, by about $10. That pushes it up towards $80 by the end of the year. This creates tangible, on-paper value for shareholders that has nothing to do with quarterly earnings.
Okay, so let's recap. We have an enormous, undeniable earnings beat and a major strategic move that unlocks a ton of value. So that brings us right back to our central mystery. With all this good news, why on earth did the market sell the stock? The numbers really tell the tale here. The day after the earnings call, the stock dropped almost 7%, from 195 down to about 181. And look at the trading volume. It absolutely surged, way above its recent average. That's a classic signal that big institutional investors are repositioning. And this captures that shift in sentiment perfectly. While some analysts, like Compass Point, stayed bullish, Oppenheimer issued a pretty significant downgrade from outperform to market perform.
For a stock that had already had such a huge run-up, a key downgrade like that can be a powerful reason for people to take some chips off the table.
So when you put all the pieces together, you see the sell-off wasn't about one single thing. It was this perfect storm of concerns. That small revenue miss, real questions about whether that amazing loss ratio could last, and just classic sell-the-news behavior from investors locking in profits after the stock had already run up more than 50% on the year.
All right, that brings us to our final take. Let's pull all these conflicting signals together and try to paint a clear picture of what we think comes next. This is the next call. So here's our prediction. For the next call, the single most important number to watch is going to be that combined ratio. Management has guided that they can sustain a sub-80 level. They absolutely have to deliver on that to prove this quarter wasn't just a lucky fluke. Because of that uncertainty, we expect the stock to be pretty range-bound for a while, as the market digests the Exzeo IPO and waits for more clarity on next year's reinsurance costs. And for those reasons, we're giving this a market perform rating. The company has executed beautifully, but the easy money has likely already been made.
And as always, a final reminder, this is not financial advice.